Unlock the secrets to smart home ownership and financial success with Home and Finance Insights. Whether you're a first-time buyer, seasoned homeowner, or real estate professional, this podcast delivers expert advice on home financing, insurance, tax strategies, wealth building, and more. Hosted by a mortgage and real estate pro who's been in the game for decades, we interview top industry experts to share actionable insights that help you protect, grow, and maximize your home investment.
Welcome to Home and Finance Insights. I'm Kevin Mathews, a longtime mortgage advisor with Empire Home Loans, and today we're diving into a topic that is often misunderstood, sometimes controversial, but incredibly important, and that's reverse mortgages. Whether you're a homeowner approaching retirement, a real estate professional advising senior clients, or just someone curious about how these loans work, this episode is for you. We're going to unpack the mechanics, challenge the myths, and get real about who reverse mortgages help and who they don't. Joining me today is Brad Byrnes, an account executive with Finance of America who specializes exclusively in reverse mortgages. Brad's been in the trenches helping seniors navigate this space for years, and he's here to answer the tough questions. I'll be asking the kinds of questions that homeowners, heirs, and even skeptics often raise. So before we dive into the details, Brad, why don't you take a moment to introduce yourself? Tell us a bit about your background, your role at Finance of America, and how you got into reverse mortgage space.
Sure. Thanks for having me. As always, it's a great topic. Once again, thanks, Kevin. My background, I've been in mortgage since 2000, and I got into the reverse mortgage space in 2006 just by accident. I had a mortgage company, and I had a nice senior client that was in what we call back then a NAGAM loan, and she's about to lose her property. So I hunted down a solution which was called, a reverse mortgage. I knew nothing about them at the time, and I learned about it to help that one client, and it was just a great feeling for me to be able to assist somebody to save their property and eliminate that stressor. So from then, it was kind of always a part of my product mix where I offered reverse mortgages. And then 2008 came, and we all know what happened there with the market. But with seniors, or reverse mortgages in general, not just seniors. I mean, the reality is there's needs, right? Everybody has needs. Everybody has certain items or needs, and a reverse mortgage accomplishes a lot of those needs for the senior client. So I've kind of just stayed in the space because I like helping people. So the reality for there was, it wasn't just about rates and fees and this and that. It was truly about helping a client with their need or the retirement strategies.
Okay, good deal. And just to clarify, you work in the wholesale loan department where mortgage brokers such as myself originate the loan with your company.
Correct. The last 9 years with Finance of America Reverse as an account executive, helping brokers nationally.
So let's talk about the reverse mortgage. What is it, and how does it differ from a traditional mortgage?
So I might explain it a little different than everybody else in the universe.
Let's hear it.
For me, a reverse mortgage is no different than any other loan, right? It just has the option of no payment. So a lot of people get stuck up on the idea of like, well, do you share an equity? No. Do we go untitled? No. Do you have a prepayment penalty? No. Those are things that people get concerned about. Well, what happens? You get a mortgage statement each month, and what the mortgage statement shows is what the deferred interest is. Now, a lot of people don't understand or don't think about the fact that you can make a payment to a reverse mortgage. So you could treat it like a traditional loan. So I like to think of a reverse mortgage as nothing more than an option payment for a senior. They can make payments or they don't have to make payments. If they don't make a payment to a reverse mortgage, what happens? The equity in the property ends up making the interest payment for them, right? The interest is being deferred over time. That's the easiest concept, but what gets stuck is, that mystery of when you attack it and the idea of, well, let's eliminate your monthly mortgage payment. That seems too good to be true. Well, it's not. Your equity is making the payment for you, right? But you also have the rights to make payments, which is a very key important part here. It's the freedom to make a choice, a freedom to choose what you want to do, to make a payment or not make a payment, treat it like a traditional loan, or let your equity assist you, right? So those are factors that I like to focus.
If someone does let the equity make their payment, the difference between that and a conventional loan, you don't have that choice. You have to make the payments, and your mortgage balance comes down each month, whereas the reverse, your mortgage balance increases each month that you're not making the payment.
Correct. Your loan balance is going up, so what I say is your equity is making that payment for you because the loan balance is going up. So then when you refinance or sell the property, you're paying off the loan balance that's due, right? And the remaining equity is still paid to you or your heirs. So that's the factor there. But the idea of, like you were saying, a traditional loan, if you had a traditional loan and you stopped making payments to it, what would happen? The loan would most likely be called due. You would have negative credit. Well, if you took a reverse mortgage out and treat it like a traditional loan, making payments to it, and let's say something happened to you where you couldn't afford the payment for a while, we had hardship, it's not reporting to credit. You're not going to lose your property. And then when you get back on your feet, you can start making payments to it. So to me, a reverse mortgage is way more than just the idea of eliminate your mortgage payment. It's a freedom to choose, the idea that you can make a payment or not make a payment, and then how that happens. Like retirement insurance. I don't want the insurance, but I need it, right? And I have to get it before the accident happens. So the reality to me is reverse is like insurance for retirement. Get it? Hope you don't need it. Make payments to it while you can. Keep paying down your loan balance. And then if something bad happens, you know what I mean? Until you can reset. Yes.
Okay. And who qualifies for a reverse mortgage? What are the age requirements?
FHA HECM is a home equity conversion mortgage. So FHA has a great product that starts at age 62. One spouse has to be 62. So you could be 62 married to somebody younger, and we still could look at a reverse mortgage on an FHA file. We also have our own portfolio products that start at age 55 called Home Safe. So you do have a great range, age 55 plus for prop products, or one spouse 62 on an FHA HECM. So your qualifications are age and equity based. The older you are, the more we lend. Also, rates play a factor because the lower the interest rates are, we're deferring less interest over time. So that helps with your lending.
And tell me if I'm wrong, but there's a calculation that is done somewhere about life expectancy and how that plays out with the amount of money you can receive and based on your equity too.
That is right. Everything's based on age, right? So life expectancy tables, those charts are real. And that's why when you go to the idea of the older you are, the more we lend, right? Because they're going to hold the loan for less amount of time, I guess.
Right. No.
When you're looking at it. So we're deferring less interest over time. Yes. So, I mean, if you're 55, right, the LTV or the amount we'll lend is a lot less than someone if they're 80, right? Because just based on that curve. And there is what we call financial assessment. I know most loans you're looking at DTI, debt to income ratios. We look at residual income. So it's really just a component of what your income looks like versus your minimum payments. Now, we're not including the mortgage payment because that's not an obligation anymore. So you're looking at just minimum revolving installment, taxes, insurance versus your income. But you can also use reverse proceeds as an asset, other assets to help. We now also offer impound accounts. What you call an impound account, we call a life expectancy set aside, which is eliminating the mortgage payment and the taxes and insurance. So now they don't have those obligations. The products come a long way over the years to help these senior clients in different ways.
All right. Well, and we'll dig into that too. What types of properties are eligible for reverse?
FHA has a really nice range. That's a single family, right? 2 to 4 unit, manufactured homes, single wide, double wide, condos. So it's really wide open on the FHA side. And for our prop products, we pretty much do the same ideas. We just don't lend on manufactured homes on that side of it. So really all of it's available. There's not anything that you would say no to. Everything's case by case though.
Yeah, what if the property is not in good shape, needs a lot of work, the appraiser calls out a lot of things that need to be fixed? How does that work?
The great question. You see a lot of deferred maintenance in our world, right? People are on fixed income, things they have deferred maintenance. They don't have those additional income streams or money to make the repairs. The reverse mortgage can help. A lot of people or a lot of senior clients will come to us with those same ideas that, hey, look, my property needs an update, or I have, some other issues going on. And we can look at it in two ways. If it's not health and safety, we can um, look at a repair set aside, fund the loan, put money into a repair rider and give them 6 months to do the repairs with the funds, and then, get the money out of escrow. So that's easy. There's also opportunities to hire a contractor based on what's called out in the appraisal. Now, it has to be called out in the appraisal. It can't be, well, I want my kitchen remodeled. It's got to be something that is there that the appraiser says, okay, this is a deficiency. Then you can look at having a contractor come in, do the repairs needed, invoice escrow, and pay that way. So a lot of the clients might get stuck, well, I don't have the money to do these repairs, so I can't go get this loan. That's not true. We have ways to assist within the program.
Are there different types of reverse mortgages?
Yes. I mean, since I got in the mortgage industry in 2000 and since 2006, when I wrote my first reverse mortgage, we've come out with a lot of different products, which has been great. Great because more products mean we can help more people. So it's actually been a big change in my market. So you have your traditional FHA products, adjustable rates and fixed rates. You have prop products in my market, my company. They're called Home Safe. You have fixed rates and adjustable rates, different rate options, different LTV curves. We also have a reverse second, which has been a huge player the last couple of years for us because a lot of people have low fixed rate first mortgages. They don't want to touch it, but they need access to some equity. A reverse second's been a big player for a lot of people to help them.
I wanted to ask you about that second program because I know that's been pretty new. I've just recently seen it as well. The second mortgage program seems like a good idea because there's so many homeowners that have that first mortgage that's at 2.5% or 3%, and they don't want to touch that. They don't want to pay that off right away. They just want to let that ride, but they still need money for things. And that second mortgage program sounds like that's a good idea.
And going to get a reverse second versus a senior client going to bank line of credit. Nothing against bank lines of credit. It's just if you use it, you have a payment and eventually have a balloon payment. So now you're going to have to do something in the future because you still don't want to touch that really low 2% rate you got or 3% rate you got on your first. No one's ever going to want to touch those if they don't have to, right? So reverse second allows you to get the mortgage, get the loan with no payment, no balloon. And like we talked about from the beginning, still throw money at it, still make payments if you want to on it. So we're seeing a lot of clients get it, treat it like a traditional loan, make payments to it. But the idea of equity, there's no limits to what you can do equity. It's bridge retirement gap, help your client buy a second home, build the ADU, remodel your property, help your kids with a down payment as an early gift so they can buy a property. Really, it's pretty awesome and exciting to see the different ways people have used their equity to help. It's really unlimited.
Otherwise, that equity is just sitting there, not being used. And the only other way is to take out a loan where they have to make those payments, and maybe they can't
Correct.
afford that.
Yeah. Any other time you do, it's a loan and you have a payment. And if you've got a client that's potential on fixed income or is going to be in the future on fixed income, maybe not today. Maybe today they're still working, they have other income streams coming in, but maybe in the near future they're going to lose some income streams. And now you're talking about, well, I can't really take on that additional payment. Well, how do you create a fixed asset to a liquid asset without having a payment stream? That is where you're looking at it, right? That's a different level. It's not need-based. I need this product. Now I'm looking at the idea of I'm going to get access to my equity and I'm going to use it And how am I going to use that? Is it going to be in the background as an insurance policy? Is it going to be to pay off other debt? Is it going to be to protect my other assets against down markets? There's just so many different ways to look at it. But yeah, the idea
Yeah.
of turning a fixed asset to a liquid asset, and now let's just call it like, I don't know, equity savings account.
Right. No, it makes sense. The other thing I was going to point out is that let's say somebody has a lot of equity in their home, maybe over $1 million, and traditionally the way to get that money out, if they don't want to make a payment on a new loan, is to sell the property. But then you could have potential tax ramifications from capital gains. And correct me if I'm wrong, it's not a taxable event by taking out a reverse mortgage. The payments you receive.
Yeah, I mean, that brings up a good story that it's a touchy one for me. It's one of the clients I got really close with. You get close to your clients, and, nice gentleman, Seal Beach, California, had a lot of assets. First time we talked, he like, I don't need a reverse mortgage. And I asked him, is it okay for me to follow up every 6 months? He said, why waste your time? And I was like, oh, just, life, things change in life. We don't know. We don't have a crystal ball. And so I'll just check in, and checked in 6 months. And he was like, wow, you called me. I'm surprised. Then we came to the next time, he called me. And I was like, oh no. And he's like, what? I'm like, well, you're calling me. That tells me something changed. And unfortunately, yeah, his wife had fallen and hit her head, and he needed to do full-time care. And it was costing about $9,000 a month to keep his wife home with full-time care. And he hadn't planned for that. So he was liquidating assets, and he remembered what you just said, that the reverse equity isn't taxed. Well, as other assets, as he's liquidating them, he was being taxed on them. So then that triggered in his head, wow, I'm going to go get a reverse mortgage, use my equity to pay for this instead of getting the tax hits for liquidating my assets.
Let's dig into some myths now. I hear from a lot of clients, and when we bring up the subject of reverse mortgages, oh, I don't need that. The bank's going to take my house, or I won't have anything left to give to my kids. So let's talk about these one by one. The first one is, does the bank take ownership of the home once a reverse mortgage is in place?
No, we do not go on title. We do not share in equity. We have nothing there. We're just a lien.
Okay. And can a homeowner be forced out of their home due to a reverse mortgage?
So a reverse mortgage is not going to force them out of their house. It's going to be something's triggered, right? The trigger being, we only lend on primary residences. So if it's no longer your primary residence, if you're out of the house with no intent to return, that could be an event that would trigger the reverse mortgage to be called due. So once the loan's called due, now you have obligations to refinance the property or reach out to servicing to figure out what the solution is, right? So primary residences, pay your taxes, insurance, then you're golden. There's nothing that can happen, but it has to be primary residence.
I've heard if you don't maintain the property, that can also be another reason for the lender to say, hey, you got to take care of it, or they're going to call the loan due. Is that correct?
Yes, and if you look at your loan docs, it talks about that, but that's no different than anything else. The collateral needs to be, maintained so that it's holding its value. Since 2006, since I've been writing these reverse mortgages, I haven't seen anything come of that stuff. But once again, it comes down to maintaining the property that's the asset that we're.
And how would you know if they're not taking care of the property either? I mean, that they'd have to send out an audit team, right? They're not inspecting the property. I guess they could do a drive-by, but they're not coming into your property to make sure you've maintained and that you kept things up on the inside.
Yeah, no one's knocking on doors and doing surprise visits. So,
right.
I mean, today's technology, you have stuff that you can use, right? Satellite views, things of that nature. But honestly, come on. That's a difficult one to even talk about. I mean, it's there for the reasons it's there for, because it's the collateral that we're lending on. So we just don't want somebody just the collateral to go, you know what I mean, just to be totally shredded.
Right. And traditional loans, which is most of my business, we have clauses in the deed of trust that talk about waste, which is if your property is dilapidated and you tear it down or something like that, that would call the loan due because just like you said, it's security for that loan. So it's still in other loans too. Conventional and reverse are no different in that respect. Okay. All right. What happens if the homeowner outlives the value of the home?
Nothing. I mean, all our products are non-recourse, so they're insured. So let's say the non-recourse just means that you can never owe more than the value of the property. So if you were to ever owe more than the value of the property, the loan's not called due. And if something were to happen, nothing's passed on to your heirs. If you're out of the house permanently and can't return, the loan might be called due. And let's say you owe more than the value of the property, none of that's going to your estate, none of that's going to your heirs. The insurance policy will then kick in and cover the difference. So all our products are insured and they're called non-recourse loans. You can never owe more than the value of the property. And if you were to go upside down or underwater, the loan, like most important part here is the loan's not called due, right? The senior continues to live in the property for as long as they want to.
Just to clarify, let's just say that somebody does have an event and they move out of the house, maybe they went to assisted living or they went to live with a relative and the reverse mortgage is now called due. What's the process? What happens then? The reverse mortgage company sends a notice, says, hey, you got to either pay this off or sell the house or what?
Well, what's preferred is that they're proactive. The heirs are proactive, right? Now, it doesn't always happen this way because sometimes the heirs don't know that the senior client had a reverse mortgage. They might not know all the factors, but the hope is that the heirs are proactive and reach out to alert servicing of what their intent is. Is it to refinance or sell the property so that we can get on the same page and say, okay, your goal is to sell the property, here are the timelines, or we're looking to refinance the property and here are the timelines. That's the goal, is to be proactive with servicing and alert them what your intent is. What's written is that the heirs have 6 months to refinance or sell the property, but once again, alerting us of what their intent is with extensions of 3 month periods, so up to a year, to then go for it. Like refinance
make a
or
decision.
sell the property. Yeah, because a lot of the times it takes time, right? It takes time to make a decision of what they want to do. Are they going to remodel the property, update it to put it on the market? Is there anybody that actually wants the property, or is it we just need to clean it out and get it on the market?
Okay. And a situation where, let's say that, and we know this hasn't happened very often, but let's say that reverse mortgage client or borrower is upside down on their property. They'd go to assisted living and they can't sell the property for as much as the lien that's secured against the property. In that instance, what do? They can call the reverse mortgage lender and say, I want to give the property back. Is that essentially it?
Yeah, and that's essentially no different than what you deal with in traditional markets. If there's no value to them, time and energy is spent, right? They're not going to have any additional equity that's going to be given to them because it's upside down. Odds are they're going to be calling servicing or just walking away from the property and doing servicing the keys, and then we would list the property, sell it, and so on and so forth. Yep.
And that's where your insurance kicks in to take care of that. So you guys aren't having to fund that.
Yeah, I mean, there's a lot of stuff written, all that we can go deep dive into, but the end of it is, yeah, the heirs will make decisions based on what's worthwhile to them, right?
Mm-hmm.
And then those decisions will be discussed with servicing, and then the appropriate actions will be taken. But servicing works with them. I've seen lots of different ideas and different things that have happened where there's been delays and they show the real intent to trying to get things resolved. I've seen lots of, different extensions or different things happen over the years.
Okay. It sounds like they just need to communicate and work with you guys if
Yeah,
that happens.
that would be my biggest advice. If anything were to trigger like that, is communication is key so that they can work with the senior client or the heirs and figure out what's going on, even if it's tax default or insurance lapses. All those things happen. It just needs to be communicated with servicing so they can figure out the right strategies. The last goal
Okay.
of any loan is to foreclose or to take the property from a client. That's the last thing. None of us want that.
Right. And compare this to traditional mortgage. If you were upside down on it with a traditional mortgage, your option is a short sale, which then goes against your credit and is a huge hassle. I remember helping clients with many of those during those years, and you do too. But yeah, it's a totally different animal and it's not good.
Like you said, it's a lot of that process is heavy intensive to get approved by the lender, to do the short sale, to do all the things, to get listed, and then the negative effects that follow you after. That's not the case here. None of this follows the heirs. None of this will follow the estate. It is really just conversation with servicing on the exit strategy of the property, and then it's from there. Yeah.
Okay. And a situation where, let's say, someone has a reverse mortgage, they pass away, the heirs inherit the property, and there is equity in the property. Just like you said, I just want to reiterate, the heirs have choices. They can keep the home, they can refinance it, they can work with you and get some extensions and maybe sell it. So they still have those choices, just that their equity position would be different if they didn't have the reverse mortgage. That's all it is.
Yeah, I mean, it's no different than a traditional loan, right? Those aren't assumable. This isn't
Yeah.
assumable. So you're talking about a loan that's due and you get the payoff, and then the payoff is against the equity position, and that's the basic math. The leftover equity is the heirs, and it's their discretion what they want to do. Refinance. We see a lot of seniors had a reverse and the kids are old enough and they inherit the property, they get a reverse to pay off the parents' reverse. There's just so many different options. But yes, the basic concept is you're going to refinance or sell it.
What should families know before their loved one takes out a reverse mortgage?
Just the triggers, like the people to communicate with when an event happens. If I have a trust, I'd put it in my trust. If I have a will, I'd put it with my will. Whatever my important documents would be, I'd put my, a mortgage coupon there, letting my heirs know that I have a reverse mortgage. Please communicate to these people what your intent is. And that's something I would do, because a lot of times you are in the situation where someone passed away and you're in a mad scramble to figure out everything. I don't know if you've been through that situation, but it's not an easy one to go through and then dig through their financials and what's due and the funeral and the costs and everything else. And then think about the property is probably the last thing you're going to think about. So I would just get it in there and put it in there what the timelines are so that it can just be taken advantage. It makes things a lot easier.
One of the biggest objections that I hear, especially from the adult children of the person that is looking to take out a reverse mortgage, is that the reverse mortgage cuts into their inheritance. And yeah, it's true that loan balance grows over time, which can reduce the home's equity. But there's another side to that, because when a senior homeowner stops making the monthly mortgage payments, that frees up hundreds or thousands of dollars each month in cash that they could redirect into investments, savings, or even gifting to their heirs while they're still alive. And I think a lot of people don't realize that, is that when that money's taken, when you don't have to make that payment, that money's still going somewhere, and it could build up. You might have a house that has a large reverse mortgage lien on it, but now their investments have grown so much higher that kind of compensates. Is that what you see too?
Everything you said is awesome. I mean, really true. I mean, you run into certain heirs that, I don't know, maybe the right word, entitlement or whatever it may be, but there's so many other ways to think about it. Like if I had a savings account, do you have rights to my savings account as the heir if I need it to make the mortgage payment? Do they think about it that way? What if I can't make the mortgage payment and all of a sudden we lose the property? Now you don't have an inheritance. So you're talking about a short-sighted view of it. What if we were to use the equity, liquidate it, and increase your life estate? It's no different than any other investment. I always talk about what the short-term, long-term strategies are. So short-term might be to eliminate the monthly mortgage payment, like you were saying, to free mom and dad of that so they can have a better, month-to-month life. Long-term would be to reinvest that money into other assets and diversify it, and maybe it plays out better for the heirs. You know what I mean? It's not so easy to say that that's a simplified thing that the heirs are thinking. You're going to use the equity to make the payment, and that's my inheritance. That's a simplified thing. But what if I showed you short-term, long-term, and long-term strategy is what you're talking about? Use the additional funds and invest in other things. Why not maybe go buy a rental property and have rental income coming in from that? Now you have two properties gaining in equity. There's just different ideas. So those are
Yeah, no,
conversations.
that's very true.
Those are conversations that we had, and yes, it happens. But if you can have them and have them real and talk about short-term, long-term, and different financial strategies that could actually help the life estate versus what if she stops making the payment and what happens to the house if she can't afford the mortgage, then you're going the other way with it. It's no longer your inheritance. You've lost everything.
We're also talking about the emotional appeal of having an aging parent stay in the house. They have a lot of emotions tied there, and they may want to stay and they can't afford it. This is where the reverse really comes in. Do you have any examples about that?
If you look at some of the data that we have, there's 10,000 seniors turning 65 a day, right? 10,000. I think it's close to $17 trillion worth of equity. So there's a lot of equity at play to help seniors. It's just a matter of how they're going to use it, like we talked about. Now, the strategies is, yes, seniors want to live in their own home. Their biggest fears are outliving their retirement strategies, becoming independent. They don't want to lose their independence. They don't like that idea. And they want to age in place. They want to stay in their home. I'm not there yet. I'll be there soon. I'm 55 this year, so I can get a reverse mortgage. And the idea is intriguing to me for lots of different reasons, but to age in place and not to have to worry about that would be a big factor for my thought process as well.
So how can a reverse mortgage be used strategically in retirement planning? Are you finding financial advisors using this tool more and more?
Yes. I mean, I've been working on that side of it for a very long time. Education is a big factor for me. Financial planners, are seeing more and more of this as an opportunity to help seniors bridge the gap for retirement. And it might not just be the idea of, well, we're going to take the equity position and use it. Maybe the idea is we're going to have it in the background as an insurance policy to protect other assets. So let's say you have all your other investments in your portfolio is underperforming. Do you want to sell off any underperforming assets? Probably the answer is no, you don't. So therefore you want to use equity until the asset rebounds. And when the asset rebounds, then you start looking at your assets again and not equity. So it's kind of playing the two of them together to ensure your portfolio, to ensure your asset. Yes, it's becoming more and more a situation where you're getting access to equity as an insurance policy per se.
Got it. Got it. Yeah, I've noticed that too. That because for a long time, financial planners were totally against reverse mortgages. Okay. Let's talk about, can reverse mortgages delay Social Security?
I mean, it's non-taxed, right? So it's not affecting any of that stuff. It'd be a choice. You see a lot of people delay taking Social Security and use equity to delay that so that they can take it later and get a bigger, chunk. Yeah.
And I've heard a lot about the reverse mortgages being used for long-term care planning with the reverse mortgage line of credit. How does that work?
I've seen it in so many different ways. I mean, long-term care policies are very expensive. So instead of a long-term care policy, some people are just going to get access to their equity instead of a long-term care policy because those could be very expensive. So I've also seen different care plans. It's not a one fits all, it's a strategy, right? It's how am I going to use equity to assist and have it in place to be there when I need it. Like I had a conversation with a gentleman the other day where he told me his dad needed a large chunk of money to get a bed at a care facility and he had to have it next day or the bed's going to be not available. So he had to come up with close to $30,000 to get in this facility. And it was like I had to liquidate a bunch of stuff. He's like, I wish I would have had the reverse mortgage for my dad available so that I could just hold that and then use that money to get my dad into the assisted facility. So it kind of goes back to the forward thinking. Do you get it before the accident or after? Insurance, right? We need to think about it proactively, get the stuff put in place before it happens.
I wanted to explain the line of credit for reverse for exactly what you're talking about, because I don't think a lot of people understand how that works. Can you take us through a line of credit and how that type of reverse mortgage would apply here?
Yeah, a lot of what we write is adjustable rate reverse mortgages with lines of credit. And that surprises a lot of people. And the reason we write a lot of adjustables is because of the access to a line of credit. So on a traditional HECM, home equity conversion FHA program, you can get a first trust deed mortgage, pay off your existing mortgage, right? Maybe get access to some cash if you need it, and then leave the rest in a line of credit that's sitting there in the background. Now, the good news to that is you're not charged interest on the money until you draw it from it or use it. So therefore, that's a big win, right? Instead of having mattress money on funds you might not need and being charged interest. So that's one factor that's beneficial. The other major factor is the line of credit in the reverse world has a growth rate to it. It's growing as it sits there. It's not just sitting there stagnant. It's got a growth rate to it that mirrors the interest rate that's being charged. So if you've got $300,000 in a line of credit sitting there and your interest is 6.5%, your growth rate on the line of credit is 6.5%. Now it's not earned interest, it's growth. So that allows the senior to have access to more funds over their lifetime. And that's a huge thing because that's one of the main fears, right? Not losing your independence, outliving your retirement assets. So this allows them to have access to more of it.
When you say growth, it just means that the equity, the amount of money that's available on that line of credit is increasing each year.
Correct.
How much they can have access to it. And that
Correct.
continues. It doesn't have anything to do with the value of the home or anything else. This is set in stone, essentially.
Well,
tied to the interest rate.
The growth rate will adjust, right? Because it's adjustable rate. So the rate will come down or up based on the index. The margin is set, but the index will adjust. So the growth rate will also adjust based on the index. It can go up or down, the growth rate. But what you hit on more importantly is that line of credit can't be frozen. So if something bad happens to the market, that line can't be frozen. That line of credit is growing independent no matter what the market value is doing. So even if the values of the property go down, that line of credit is going to continue to grow. As our example would be 6.5%, it's going to continue to grow for them. Versus even if they're upside down or not, the market doesn't matter. So that's a huge, to me, win in insurance policy to know that I have this available. Because I don't know if you went through it, but I went through it in 2008 when I had a line of credit right when I needed it. It was frozen.
Right. That happened to a ton of people.
Yeah, the factors are that that's a nice feature to this product. And there's a lot of nice features to the reverse mortgage that are protective features that protect the senior client.
Yeah, I'm glad you pointed that out because that is a huge difference.
The LA fires, people that had reverse mortgages in the LA fires, those lines were still available to them, even though the property was no longer there.
because they had it, the reverse mortgage company allowed them time to rebuild in special circumstance. They're not just saying, hey, the loan's due because the fire destroyed it. They worked with them.
And the line of
Okay.
credits weren't turned off either. They were there, so they could still continue to use them.
What about a homeowner that is elderly? They been living in their home forever. They have plenty of equity, but the home doesn't fit their needs anymore. It's too big. It's a 2-story. It needs a lot of maintenance that they're just not capable of. It's not set up for wheelchair access. So instead of a reverse mortgage, it might be better for them to sell that home and downsize. But when they do that, they have an option of doing what's called a reverse mortgage purchase. So could you kind of expand on that? How does that work?
First of all, I don't call it downsizing. I
Okay.
retagged it right sizing. We're right
Right sizing. Okay. All
There
right.
you
Well,
go. We're right
mine's an
sizing.
old.
We right size a lot of people. So yes, you're right sizing somebody because everything you hit on, 2-story, maybe it's a large property, it's the family home. They no longer need that. It might be for lots of different reasons. So yes, you can sell that property and right size to maybe a 55 plus community or maybe a more retirement friendly state, whatever you're looking to accomplish, a single story, all those factors, yes, you can right size. And the benefits there are the same as anything else. You're using equity. You could do an all cash, right? Probably sell the family property and then buy a new property with all cash. But with a reverse purchase, you keep liquidity because you're only going to need a certain percent down, and the rest of the funds can be used to help with retirement.
And it might be a situation where, let's say they get $500,000 out of the sale of their home, but the right-sized home cost them $800,000. So they wouldn't be able to afford to pay cash for that home without getting a loan, and maybe they don't have the capability of making that payment. So that's where a reverse mortgage purchase could really come in to make up that difference.
Yeah, you get that because, like you said, the qualification side of things, like a senior might feel stuck, like, oh, my FICO's not there, my DTI's not there, my income's not there. Oh my gosh, my property's in disrepair and I'm going to put it on the market. This is overwhelming. There's a lot of agents out there that will help right size, get seniors set up to list the property. And then as far as the reverse mortgage goes, can help them get into new property, but it also increases purchasing power. So maybe you have the senior that has 300,000 for a down payment, but there's no inventory at 300,000 and they can't qualify for traditional loans. So an all cash 300 doesn't get them anything. So what is their option? Maybe it's to do a reverse purchase, put the 300 down and then open up inventory, increase their purchasing power. Maybe they can afford a $650,000, a $700,000 property. Yeah.
The reverse mortgage purchase, do those take longer than traditional loans? Because I know that a lot of times if it's in a hot market, sellers want to close within a short time frame. How quick can we do a reverse mortgage purchase?
Right now, we're averaging 27 days or less on loans, period, and purchases take priority. So we fund them pretty quickly, but it's going to be case by case by each person in their file. But on average, it's not that big a deal. What you run into more is maybe the agents don't understand the reverse side of it, the reverse purchase side of it. So when an offer is being made, they're no different than anything else. They're going to take an all cash offer before other offers, right?
True.
So sometimes what we see is a senior client going in, buying all cash, moving into the property, and then reversing it after the fact to get their equity back out. So either way works. So you can look at those different angles.
Okay. One of the other things that I hear a lot from clients that don't understand reverse or some that do understand is the closing costs. There are higher closing costs for reverse mortgage. Why is that?
Well, all the things we talked about for the last 50 plus minutes, right, that were on here is all the great aspects of a reverse mortgage. Non-recourse, growth rate line of credit can't be frozen. All those factors lead into why you're insuring that, right? And the insurance policy is what's cost that's costly. So FHA has a 2% upfront mortgage insurance premium on their files, and that's where the big cost is. If you go to our Home Safe portfolio products, we don't have that upfront mortgage insurance premium, so it's not the fee. If you want, I guess you could say it's baked into the rate, but they're all insured. It's just FH is an upfront insurance policy, and that's where the fee comes in.
Majority of that.
Yeah, where it's like, oh my God, 2% of $1 million property is $20,000. So they hit on that, but they have to remember what they're getting for that. They're getting all those protective aspects, the fact that someone's going to land on their property that's not going to get a payment until they refinance, sell the property. Right? So all those, what I call benefits of the insurance policy.
And other closing costs are pretty much the same. Title,
Yeah.
escrow, appraisal, all that, and
Yeah,
lender's fees. It's usually
normal, traditional, third-party costs, title, escrow, appraisal, all those factors. Yes, those are standard. The one that's hit on all the time throughout my whole career is the insurance. Yes.
I wanted to share something with you or to the audience, just to let them know. Years ago, I had a client that I originated a reverse mortgage for, and they were in real tough financial shape. They loved their home, but they struggled with the mortgage payment. They didn't have enough to maintain that and have a healthy lifestyle. And they were considering selling, but then they really didn't have many options. They knew that if they sold, they didn't really have a good place to go. And the reverse mortgage really worked for them. It paid off their existing mortgage, eliminated that payment, and they received like $1,000 a month tax-free to supplement their income. And they were able to stay in the home. And years later, the husband passed away, and the wife lived in the home for a number of years by herself, but she realized that the home was just too much for her to maintain, and she ended up wanting to move in with her children out of state. And what happened was, when she went to sell, she didn't really pay attention to the reverse mortgage stuff back then, but she still had plenty of equity, and she got a sizable chunk of money out of that, and she ended up being in a much better position because she had the reverse mortgage. And I was really glad that they did that, because otherwise they really didn't have many other good options. So it does work sometimes. I'm sure you have stories like that all the time, where it's just been great for people.
Yeah, I do. I mean, I've been very blessed to be able to help a lot of people, and this product does. I mean, let's be honest. I mean, not every loan, every program's made for everybody. A reverse mortgage isn't for everybody, but there's a lot of benefit to a lot of people, because there's really no different. It's really wide open to how that individual needs it, short term and long term. So the way you structure it, like you said, where you get access to equity and eliminate those stressors, they're all there and they're all good. And we've been blessed also to be in good markets, to where if you have growth rate of your property that's exceeding the deferred interest, you're going to gain equity, right? So it's not, if I'm growing at growth is 7% and the cost of funds is 6%, I'm still gaining equity. I'm not on the other side of it, right? Where if interest rates are 10% and I'm only gaining my equity growth over historicals, 7%, you're on the other side of it. So we've been in good positions for a long time to help a lot of seniors, and we still are. So yeah, I have a lot of really cool stories that I've been able to help a lot of people. And, there's a lot of people out there that could benefit from a reverse mortgage in different ways. It's just a matter of education, like you're doing here, which is tremendous, to get education on different ideas and different ways to use the reverse mortgage to help the seniors' needs.
What type of client shouldn't get a reverse mortgage? Give us a situation where it's really not a good idea for someone.
I definitely wouldn't do a reverse mortgage for a short-term strategy. If it's just hey, I'm going to get the reverse mortgage to remodel my house and sell it, that to me is not a good strategy, because it costs so much. If the strategies are short-term, long-term, where the goal is to stay in the property, then the savings outweighs the cost. No different than what we think about traditional loans, right? You're always looking at the cost of the product or the loan versus, how long you're going to be in it. So to me, I would probably say anything that's a short-term strategy isn't the best play or the best idea or the best benefit to the senior. But all the other ones, really pay out. There's no one where I'd say, no, this isn't a great idea. I've had seniors in the past where they were short to close. They didn't have enough equity to not have to bring money in to close. And they saw that if they were to keep living the way they were living, they would blow through their retirement and have no money and then lose the property and be on that other side of things, where if they use some of their retirement now to bring the money in to eliminate the monthly mortgage payment, that at least secured the property forever for them, for as long as they live. They could never not be there, right? So that was securing that idea of living in place, aging in place. The rest of it they could take care of if it meant getting additional income streams other places. So they came in with money to close, and it wasn't a small chunk of money that they brought in to eliminate the mortgage payment and free them of that and secure that property, because they saw the writing that they were bleeding their assets, and eventually they're gonna run out of assets and not be able to afford the house, like you said, and then sell the house and then have to go rent someplace. And this cycle was going to continue for them.
I know that the reverse mortgage borrower has to go through a financial counseling. What role does that play in this? What is the counseling like for them?
Well, I love counseling personally. I mean, granted, not all counseling is equal, right? It's like everything in life. But counseling as a concept is a great idea because it's a neutral third-party counseling session that's about 30 to 45 minutes over the phone. And the senior calls up, schedules the appointment, and they go through that neutral counseling session where they go over ideas of the product. They might go over some financial ideas for the senior, idea where they're currently, that short-term, long-term ideas of how this might be a benefit to them financially. But the idea is to go over the product so they're educated enough by the product, not just by the loan officer. Seniors are a protected class, so it's protecting the lender, the broker, the LO, the senior, it's protecting all of us, that the senior's in a good frame of mind and able to make the decision with some understanding of the product, not just based on one person's discussion with the client. So yeah, there's a lot of benefit to there, in my opinion.
I've noticed over the years that the reverse mortgage product has gotten better. They've put more safeguards in place to protect borrowers from unscrupulous lenders and loan officers that get them into something that they really shouldn't be. And I think the counseling helps a lot in that regard. Is that what you found too?
Yeah, I mean,
Versus,
I think so. I mean, there's been some things that I'm like, I'm not a real fan of it, but the reality is it's beneficial. I mean, it might be sometimes make things harder, but there's benefit to it. So when I got into reverse mortgages in 2006, there was no financial assessment. It was really age-based lending. We lent on age. We didn't look at credit. We didn't look at financials. We didn't look at any of that stuff. So now we do take a peek at, their financial assessment to make sure that they have enough money each month left over to continue to have a quality of life, that it's just not the reverse mortgage. They're not just living off the reverse mortgage, that they can, have enough residual income to support themselves. So that's great. I like that side of it for all the reasons we've discussed here. Also, we now have an impound account, or a LISA, a life expectancy set aside, which we didn't have before. And then they've also safeguarded us from, removing spouses from the loan, so that when the loan's called due, the one spouse isn't in harm's way. I really enjoy that they've done these things. It's protective. If you look back at the negative things said about reverses, it was because of foreclosures, and the foreclosures were tax default foreclosures. Well, now we can have impound accounts. The other ones were They removed the younger spouse so they could get a higher LTV. We no longer allow that. The other spouse is now protected. So you could be 62, married to a 50-year-old, and we're still going to write the loan, and we're going to write it on the 50-year-old's LTV or their age. So when the older spouse passes, the younger spouse is still protected and stays in the property. So those are a lot of great things they've done, like you were saying, to protect the senior client.
Is there anything else you wanted to add that people should know?
I feel that information is power, right? So even if you don't know about the reverse or if it's right for you, if you get the information on how it works and then how it could benefit you as a senior client, then you're like, okay, that's the first step. Then it's not everybody's situation is the same. So then you have to wrap it around. What is it for me? How can it benefit me? How can my current equity position benefit me? Because not everybody's the same. I run into a lot of seniors that feel like they're on an island alone, where they're the only ones with this problem or this concern. And the reality is, no, that's not true. We all have these same concerns, aging in place, retirement strategies, cost of living. Those are all concerns we all deal with. No one's on an island by themselves. So it's a product that can help.
Yeah, no, it definitely can. All right, Brad. Well, thank you very much. I really appreciate it. And I'm sure we're going to get a good feedback from this. This will educate a lot of people.
Thank you for listening to another episode of Home and Finance Insights. If you found this information beneficial, please like, comment, share, and subscribe so that you won't miss future episodes.